Good afternoon and welcome back to our options education webinar series. Good afternoon. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be talking about maximizing profits with debit and credit spreads. And the reason I want to talk about this webinar this week is because we've been in a very, very choppy market. A lot of things going on in the markets, and we really want to make sure that you guys are utilizing your strategies correctly based on what we're currently seeing in the markets. So I really want to talk about the difference between debit versus credit spreads, what's different about them, how to construct them for those of you that are brand new, and then more importantly, showing you some real examples of some setups that we're currently seeing in the markets and showing you how you can compare trading debit versus credit spreads the correct way. I know a lot of people like to use implied volatility to decide whether they choose a debit versus credit spreads, but I want to show you how that is many times may lead you to trade suboptimal strategies. So that's why I want to break down these two strategies, show you the difference between the two with some real examples, and hopefully help drive home the point in helping you figure out what is the right strategy for your portfolio. This webinar is recorded, so for those of you that are brand new to Options Play, welcome. We do send out the recording about 30 minutes after we finish, and you'll not only get the recording, but also the slides so that you can follow along as you go along, and the slides have some important links included in there. So we have previously recorded webinars, so I'll reference a few different things during our webinar today, talking about other webinars. So if you're interested in learning about them, you can use these links to get to those. We also have daily trading ideas and how to subscribe to Options Play. And for those of you that are brand new to options trading and learning about some of these strategies, if you find that some of the things that we're talking about here is new to you, please make sure you visit the Options Industry Council link at the very bottom of the second slide that I'll send out. The Options Industry Council is a great resource for you guys to learn about basic option strategies. So make sure you take a look at that if you're brand new to trading. So with that, I just want to go ahead and get started. I want to talk about, first of all, what are vertical spreads. For those of you that are brand new, the reason that we trade a lot of vertical spreads here at Options Play is because vertical spreads all have limited risk and limited reward, which means that we can plan out our trades really well. But most importantly, what that means is that when our trades don't work out the way we expect it to, we have limited risk. And that's really one of the key reasons why we use vertical spreads. But there are different types of vertical spreads, and that's really what we're here to cover is the difference between the two major categories of vertical spreads that you would trade. Make sure you understand the difference between the two so that you're utilizing them as efficiently as possible to maximize your profits. Next, I want to talk about when to use vertical spreads, because that's actually what's going to help you determine which strategy is best, whether you should be trading debit versus credit spreads. And then what I'll do is I'll get into some of the management aspect of trading credit spreads. So how to manage your trades effectively. So once you're in a trade, how do you actually decide when to take profit, when to cut your losses? And then most importantly, what I'll do is I'll spend as much time as I can using the Options Play tool to show you guys how to analyze these trades side by side, because sometimes that's the best way to decide whether you should trade a debit versus credit spread. It's putting the two side by side, putting your expected outlook on the stock, and you'll be able to see instantly which one's best suited for you. So that's really what we're going to discuss here today. So we're going to cover 4 different spreads that you can trade that are all considered the vertical spreads. And there are basically bullish and bearish spreads, and there are debit versus credit spreads. So we're going to go over each one, what each one means, how to construct them, and then most importantly, actually how to analyze them. So when we talk about debit spreads, there's 2 trades that you can make, and these are very similar to buying a call or a put. So the bullish trade is a long call vertical, and the bearish trade that you can make is a long put vertical. So same thing as buying a call or a put. Bullish calls are bullish, puts are bearish. When we're talking about credit spreads, it's basically the exact opposite. What you're going to do is you're going to be shorting a put vertical as the bullish trade, and you're going to be shorting a call vertical as the bearish trade. So we're going to break down each one of these, what the benefits of each one are, and kind of how to construct them. But the one thing that I think we should keep in mind here is that all of these strategies, debit or credit spreads, have predefined risk and reward. And the benefit for that is that when we're trading, a lot of times when we're trading, we're not just managing the trade, we're also managing our emotions. So when we're trading these vertical spreads, because we can pre-plan exactly what the best and worst case scenario before we get into a trade, we already know what is the expected outcome, which makes managing the trade once you're in it a little easier. It's a little different than buying a call or a put or buying a stock where you don't really know what the possible outcomes are before you get into the trade. And you have to kind of manage those things as you go along. Because you pre-plan a vertical spread before you get into a trade, I tend to find that they're a little easier to manage from an emotional perspective. And a lot of times that's the hardest part to manage when we're in a losing trade, is knowing when to cut our losses. So with vertical spreads, we already know that we have limited risk, which means that no matter what happens, we already know how much money we're willing to risk. So that's one of the key things that I think makes trading vertical spreads, in my opinion, a little bit more attractive than trading a lot of other strategies where you may not know what the potential outcomes are before you get into that trade. So with this, what I'm going to do is I'm going to break down debit versus credit spreads. And in this case, I'm going to use a fictitious stock XYZ trading at $100. And I'm using this simply for round numbers, so it's easy to explain. But then we're going to jump over some live examples with some stocks that we all pay attention to, such as Apple stock, I think is an interesting one to take a look at right now. Once we jump over to the real platform, I'll take a look at some Apple spreads. So first of all, when we talk about debit spreads, this is really a spread that requires, the reason we call it debit spreads is because it's a debit entry and a credit to exit that trade. So meaning money is debited out of your account to enter this trade and money is credited to your account once you exit the trade. And it's actually pretty simple to set up. A long call vertical is where you buy an at-the-money call. So let's say a $100 call on a $100 stock. And against that, what you're going to do is you're going to sell an out-of-the-money call. So let's say you sell a 110 call against that. That's how you construct a long call vertical. That's the bullish debit spread that you can trade. On the bearish side is a long put vertical. This is where we're buying a $100 put, so an at-the-money put. And we're going to sell a lower put against it, a $90 put. If you want to learn more about this specific strategy, we actually do have a webinar just on debit spreads alone. So please, if you want to learn more about debit spreads, please take a look at that recording. Credit spreads is basically the exact opposite. It's a credit to enter the trade and a debit to exit the trade. So for an example here, if you're bearish, you can sell a short call vertical. This is where instead of buying that $100 call, you're going to sell the 100 call, the at-the-money call. And because selling an 100 or an at-the-money call has unlimited risk, in order to cap that risk, what we're going to do is we're going to buy a higher call against that. And that caps the risk that we have on this short call. Conversely, on the short put vertical, this is where we're selling a $100 put instead of buying the $100 put. And same thing, when we sell a 100 put, we have unlimited risk to the downside. So in order to cap that risk, what we're going to do is we're going to buy a $90 put against that. So that's going to allow us to take the same directional view as a short put, but have limited risk. So that's how you construct a debit versus credit spread. And what I want to do is I want to break down these trades so that you have a better understanding of each one. However, we do get a lot more in depth of each one if you just go to our previously recorded webinars. So how do you actually pick the expirations and strike prices for debit versus credit spreads? And I think what I'm going to do is I'm going to break the two up. So when we think about debit spreads, what debit spreads really are is think of it as an improvement on simply outright buying a call or a put. If you're brand new to options trading, or if you've traded options before, you know that buying a call is bullish, buying a put is bearish, but that also has some limitations to that. So the reason we want to trade debit spreads is because buying calls and puts sometimes are very expensive. So the reason we trade debit spreads is because we can lower the cost of buying a call or a put by about 10 to 20% by trading a debit spread versus outright buying the call or the put. And what this does is it reduces your risk, reduces the break-even price, so the stock doesn't have to move as much in order for the strategy to be profitable. And because you are short a leg, that's also going to mitigate some of the time decay of the long leg, which allows you to maintain your exposure in that stock for a little longer, or longer than you would be able to if you're just buying an outright call or put. So to construct a debit spread, you generally want to start off with expirations that are greater than 1 month from expiration, And the reason for this is to minimize theta, minimize time decay of your option strategy. And one of the best ways to do that is simply go further out in time, because the further out in time you go, the less sensitive it is to time per day. So the strike prices on a debit spread, after testing a lot of different strategies, we generally find is that you want to buy just a slightly in the money or at the money call option, so about a 60 delta call or put, and you want to sell an out of the money option against that. And we generally find that about a 15 delta call or put is a good call or put to sell that will offset about 10 to 20% of the buy leg. And that, again, that offset will decrease your risk, decrease your break-even price, and reduce your time decay. So those are the reasons why you should consider trading a debit spread if you're currently buying calls and puts. It's an improvement over buying just an outright call or a put. Is the best way to think about buying a debit spread. Whenever you're thinking about buying a call or a put, that's when you should consider alternatively considering looking at a debit spread. It's almost like graduating to the next class, if you will. Calls and puts is options 101, debit spreads is options 201. When it comes to credit spreads, it's a completely different strategy, right? So when you're buying calls and puts, that's when you're expecting the stock to make a move in one direction or another. But selling a call or put is different. So think about a credit spread as in the vertical. What we're generally trying to do when we're selling a credit spread is we're trying to collect a credit that's roughly a third of the width of the vertical. And when I mean the width of the vertical, is referring to the distance between the two strikes. So in the previous example of a stock where you're selling the $100 put and buying the $90 put, that distance or the width is $10. So you want to collect roughly a third of that $10 in your vertical spread. So how do you do that? And what we generally find is that, number one, you want to sell credit spreads that are less than 1 month, because when you're selling options, you want to maximize theta. You want to maximize that time decay. And one of the best ways to do that is to sell shorter dated options. And what we find in terms of strike prices is you always want to sell roughly at the money call or a put, so a 50 delta call or a put. And then you want to buy back an out of the money call or put against that to make sure to reduce your risk. So you want to buy back roughly about a 25 delta call or put against the 50 delta call or put that you sell. So the rationale behind a credit spread is really the same as selling an outright call or a put, or an at the money call or a put, which is basically, you do that when you feel that the stock is near a floor or near a ceiling and you don't think it's going to continue going in one direction or another. That's the rationale between selling a naked call or a naked put. But the reason that we don't want to sell naked calls and puts is because there's limited risk. There's unlimited risk. You never want to be in that situation. So in order to offset that, what we're doing is we're buying an out of the money call or put against that to limit our risk. So the rationale behind buying a debit spread and selling a credit spread is quite different. Debit spreads, when you're expecting a move in one direction or another, the same reason you buy a call or a put with. And a credit spread is really for when you're selling a naked call or a naked put, which is really useful for when you expect the stock has hit a ceiling or a floor. And we're gonna dive into some of this and make that a little bit more tangible for those of you that are interested in learning more. So at this point, I do want to talk about the difference between debit versus credit spreads, but I just want to help drive home the point by illustrating a debit versus credit spread first, and then we'll jump back to the slides. I wanted to shift things up a little and make things a little bit more interesting in the beginning, because normally I go through all the slides, then I go to the strategies. So today I want to jump a little bit in between. So here's Apple stock. It's trading at 191. I was looking at this stock because this stock has certainly taken a huge beating. It's fell off with the whole technology sector, and it's certainly one of the ones that has taken one of the larger losses in the tech sector. And it recently has reached what I would consider fairly oversold and near support areas. So there's two ways to look at this. One, you can say that I think it's reached the support and it's likely going to bounce a little higher or stay or not go any lower. Or you can be a little bit more opportunistic and say, I think this is going to go much higher. So traditionally, if you're the two ways to play that is you can buy an outright call because you think it's going to go higher, or you can sell a put, which means that you simply just don't think it's going to go any lower. And like I said, you can think of debit and credit spreads as just graduating on these two strategies. So outright buying a call, instead of buying a call at 8.95, I'm now going to buy a call spread. So instead of just buying a December 190 call, which is the at the money call, I'm going to buy the 190 call and then sell a 210 call against that. That's what options play is designed to do, is to create these optimized calls and call debit spreads for you instantly for any strategy that you're looking to trade. So if you're bullish on Apple, you can look at buying a call versus a call spread. So here's an example of a debit spread, which is, like I said, a variation of buying a call, but because you're going to sell that 210 call against it, instead of paying $8.95 for the outright call, I'm now only going to pay $7.39. So a significant reduction in the cost of the trade, which means that I have less risk, which means that if I'm correct on this trade and the stock does go back to 210, which is where it was just last week, I'm going to make a significantly higher return on the debit spread than I do on the call. And this is the reason why we want to look at trading debit spreads, is the fact that if we're right, we're going to make a higher profit. If we're wrong, we actually end up losing less money. And that's why the strategy here on the right has the higher options play score, because not only do you get the higher profit if you're correct, you get the lower loss if you're wrong. And that's how we maximize our profits, is by graduating to these more advanced strategies from outright buying a call or a put that give us these additional benefits of lowering our costs, lowering our risk, and potentially magnifying our profits. And next, what I want to show you is what happens if I'm not confident that Apple will rally back to 220 or 210, but I simply think that it's not going to go any lower. What can you do? Traditionally, what you could do is you could just sell an outright put. You can say, I'll sell a 190 put against that. So as long as the stock stays above 190, I'm going to collect $6.45. So, which is not bad, because that's a fairly substantial amount of premium that you're going to be able to collect, as long as Apple doesn't really go much lower. Not a bad strategy. However, selling a put does have unlimited risk. So to sell a credit spread, what we're actually doing is we're just going to buy back a lower put against that. So let's say we buy back the 175 put or maybe the 180 put. And what we're going to do is we're going to basically collect, instead of 645, because we're going to pay 350 for the long leg, we're only collect 295. But now, instead of risking unlimited amounts of money, we're only going to risk $705, which is significantly less than if the stock went to zero. And that's really what we want to plan for. There's a possibility that Apple may drop. Maybe it'll drop to 160. We don't know. There's certainly, this is a big topping formation. This thing could potentially go back down to 160, 165. And if that happens, if you shorted a put, you would have lost a lot of money. Here, you only risk $705, something that many of you may be able to swallow. So this is really where we can start comparing. Should I buy a call because I think it's going to go higher? Should I buy a debit spread because I think it's going to go higher? Or should I sell a credit spread because I don't know, because I think it's just not going to go any lower? And that's what we're going to come back to. But for now, what I want to do is I want to really describe the difference between a debit spread versus credit spread, and understanding what it feels like to trade them before we go back to analyzing the two. But I just wanted to show you guys the construction of these strategies and why you should consider trading a debit versus credit spread in a way that hopefully makes some sense to everyone. So before I actually start going into that, I just want to ask a quick question. What option strategies do you prefer to trade? Do you buy long calls and puts? Do you sell covered calls and cash secured puts? Do you trade debit spreads? Do you trade credit spreads? Do you trade other option strategies, or do you not trade options at all? And you can select multiple ones, by the way. Okay, we've got about 2/3 of you have voted. So, very interesting. Almost 50-50 split between debit versus credit spreads. We usually see a few more credit spread traders than debit spread traders, which is surprising. Many of you sell cover calls. 31% of you say you buy calls and puts. 13% of you say other option strategies, and 5% of you say you do not currently trade options. So for those of you that don't trade options, I hope that this is helps inspire you to consider taking a look at options as an alternative to buying stock. because there are some additional benefits that you can trade these directional strategies with limited risk. But for those of you that buy long calls and puts, I really suggest you to consider taking a look at debit spreads, because it's really kind of graduating to the next class of more advanced strategies that give you an additional benefit. For those of you that sell cash secured puts or cover calls, and maybe not so much cover calls, but maybe if any of you sell naked calls, which I know probably not many of you do, those are those strategies that you might want to consider trading a credit spread instead, because it really allows you to still take the same rationale behind a cash secured put and a naked call, but do it with limited risk, which is the key to success in trading, is limiting your risk. So that's the results here. I'll leave that up for just a few seconds before I move on. So what I really wanted to explore here is understanding the difference between debit versus credit spreads. Now that we talked about how they're constructed, the rationale behind when to get in, I want to look at the difference between debit versus credit spreads from a probability and risk to reward perspective. And the reason that I keep drilling this in my webinars is because I still keep getting the question a lot from users: how do I find high probability trades? I get that a lot because I know intuitively that makes sense, that you always want to find trades that have high probability of winning. However, I don't think what everyone understands is that probability and risk reward are on different sides of the equation. And when you have really high probability, what ends up happening is you have really poor risk reward, and vice versa. If you have really low probability, you have really good risk to reward. So it's really trying to find the right balance between the two. So when you're trading debit spreads, these tend to be low probability of profit trades. However, on the other side of that, what you're going to get is much better risk to reward. So a lot of times when you're trading debit spreads, you're going to see that you only have about 40% of your trades are winners. However, when you win, you tend to win a lot more than what you're risking. So that's the trade-off that you get between lower probability and better risk to reward. On the flip side, when you're trading credit spreads, you tend to have high probability of winners, 80% winners, and only 20% losers. However, on the back of that, what you're doing is you're risking substantially more capital than what you're actually collecting on that trade. So this is really important to understand the difference between the two, because if you're just constantly seeking for really high winners, a really high percentage of winners, you may end up risking a lot more than you really intended to without even realizing it. And that's really the key that I want to make sure everyone understands, is the trade-off between probability and risk to reward. And to help illustrate this, what I'm going to do is show you guys what it feels like to trade a debit spread versus a credit spread. So debit spreads, what you're going to get is less winners, but bigger rewards when you are winning. It's almost like, what's the best way to think about this? If you're a gambler, it's almost like playing roulette. You don't win very often, but when you win big. So this is really kind of where it feels like, what it might feel like to trade a debit spread. You might have 5 trades where only 2 of them are winners, but each time you win $100, and the other 3 times you lose $50. Your net result is you make a $50 profit at the end of these 5 trades. Conversely, on a credit spread trader, what you're going to get is more winners, but smaller rewards. So meaning you might win most of the time. You might win 4 out of 5 trades where you win $50 each, but you have 1 losing trade that loses the previous 3, $150. Your net result is still the same at the end, right? Out of the 5 trades, even though one you win substantially less, but you win larger, the other one you win more, but you win smaller, the net result's the same. So I want to point out that many times the end result of debit versus credit spreads are quite similar. You're just a completely different path to getting there. And it's really important to understand what that path feels like in order to really understand these strategies. So now that we talked about constructing them, now we talked about the difference between the two, understand the difference between probability and risk to reward, when should you actually utilize these 2 spreads? And this is really where it goes back to my point about, think about whether you would consider buying a call or a put, or outright sell a call or a put, because that's going to help you determine whether you want to trade a debit versus credit spread. So on a debit spread, this is really when you're expecting a large, quick move in one direction or another. Think about when you would buy a call, when you would buy a put. You do that when you expect the stock's going to make a big move in the near future. This is really good for when you see a stock is about to break out of a range or break down from a range, or you're seeing it's rebounding off of support resistance level like we currently see in Apple. These are generally best for lower volatility environments, or ideal for lower volatility environments. However, I do want to point out, and I'll make a point of this in the next slides, is that just because you're in a higher volatility environment does not mean you can't trade a debit spread. And that's a key thing that I want to point out today in the next slide. When you're selling credit spreads, this is really when you're expecting a neutral or modest move. So if you expect that the stock is near a floor or support level, and you don't think it's going to go any further, but you also don't know that it's going to rally, that's when you want to sell a credit spread. When you think that the stock's just not going to make a big move, but you certainly are fairly certain that it's not going to continue going in the other direction. So a lot of times, for those of you that use technical analysis, you might be familiar with momentum indicators like RSI or MACD or stochastics that give you overbought and oversold conditions. These are ideal for selling credit spreads because when it's overbought, that means the stock is unlikely going to go much higher. That's when you might want to sell a call credit spread. When it's oversold and you feel the stock's not going to go any lower, that's when you might want to sell a put credit spread. So for those of you that use technical analysis, very useful for those momentum indicators to use credit spreads with them. Credit spreads are actually the most ideal strategy to use when you're trading with those overbought and oversold conditions. Lastly, higher volatility environments are best for credit spreads. But like I said, I'm going to talk about this in the next slide. Just because you're in a low volatility environment does not mean that credit spreads are not useful. So this is a slide that I added because I get this question a lot at the end of this one webinar, is how, do I look at volatility when I'm selecting debit versus credit spreads? And I think that a lot of people ask this question is because from other services or other platforms, you may have learned that high volatility environments, you should sell credit spreads, low volatility environments, you should trade debit spreads. And I want to point out that that certainly is a true statement. However, the inverse of that is not. And that's what I want to make sure that people understand. Because yes, high volatility environments are most ideal for credit spreads, but that doesn't mean that you can't trade a debit spread in a high volatility environment, or vice versa, that you can't trade a credit spread in a low volatility environment. And the reason for this is because whenever you trade either one of these two strategies, your exposure to delta, meaning your exposure to the moves in the underlying stock, is far, far greater to your exposure to volatility. The reason that you trade these two spreads when it's low or high is because of the Vega exposure, but your Vega exposure is actually quite small compared to your exposure if the stock makes a 1% move or the same 1 or 2% move. So what I want to make sure that people understand is that there's nothing wrong in picking a strategy using high or low volatility, but if you purely base your strategy based on volatility alone, then you may end up choosing a strategy that is suboptimal in terms of risk to reward. And I'll go back to the Apple example to show you this in a few minutes as to why if you simply just follow volatility, you may end up choosing a much more suboptimal risk reward or inefficient way of deploying your capital if you're simply using Vega or volatility to choose your strategies, when in reality, you should be using delta, which is where you think the stock's going to go. And I'll make that, I think I'll illustrate this with the actual P&L simulator using options play. So for those of you that use technical analysis, and I know many, many of you do, I want to point out kind of the difference between trading debit versus credit spreads, just for a more visual perspective. So here's a stock. It's trading between 100 and 99, and it traded within a tight range for quite some time, and it got tighter and tighter until it got to the apex of this triangle. And then eventually kind of broke out to the upside of this bearish trend line. And this is really when we've identified a breakout that a stock may make a quick, fast move higher. And eventually that's actually what happened. But these are an example of when you would ideally trade a debit spread, is when you expect the stock to make a big move higher or lower. Very similar to when you would buy a call or a put, that is when you would trade a debit spread. Conversely, when you're trading credit spreads, this is much more so for when you're expecting the stock is just more modest and a move that's not going to materialize. So for example, when I've identified a floor here where this stock traded within a tight range of 101 and 103, as you can see, every single time that the momentum indicator gave you a sell signal, that would be a time to consider selling a call credit spread. Every time it hit the floor and the momentum indicator gave you overbought or oversold rather, that's when you can sell a put credit spread. And you can actually do them over and over again multiple times on the same symbol. And that's really one of the characteristics of difference between trading debit versus credit spreads, is that many times when you're trading credit spreads, you might end up trading the same symbol over and over again for a period of time. Versus on debit spreads, you may end up trading only one symbol, or you might be trading multiple symbols all the time, because these types of opportunities like this breakout on the stock doesn't happen very often. Those are things that you might find on different stocks all the time. Versus a credit spread, you might trade it over and over again. Every time it hits oversold, you sell a put credit spread. Every time it sells, you get overbought, you sell a put credit spread. Here you get a small breakout above that resistance level. You may have entered a debit spread because you think that this stock was going to continue going higher. It would have been a losing trade because obviously the stock didn't end up breaking higher and went right back down. But the great thing about trading these debit spreads, in my opinion, is that if you're expecting a breakout and it doesn't happen, you risk relatively small amounts of capital. Versus on a credit spread, if you thought it was going to go higher but it went lower, you would have risked far more than what you're getting in that credit spread. And that's why you want to make sure that you select your strategy based on your views on the underlying stock. That's how you're going to get the most optimal strategy or the most optimal way of deploying your capital. So now that I think we've pretty much covered kind of what are debit versus credit spreads, how they're constructed differently, when you should use them, when are the ideal situations to use them in. Now let's talk about once you're in a credit or debit spread, how do you manage them? And with both strategies, risk management is absolutely key to your success with trading these. Now, when it comes to debit spreads, like I said, on the entry, you want to time entries when you expect a large move to happen. So only use these debit spreads when you're expecting the stock to make a large move in one direction or another. A lot of times breakouts, bounces off support and resistance levels, good times to consider getting into these trades. When it comes to exit strategies, this is really where debit spreads, in my opinion, are a little easier to manage. The rules are quite simple. Number one, you want to cut losses if the move simply does not materialize. So when you're expecting a big move to happen, you can see it pretty quickly if it doesn't happen, meaning if it just goes sideways or starts to pull back, it's pretty easy to say, hey, the move that I'm expecting didn't happen, time to cut my losses. This is really, and with debit spreads, the key here is almost always to exit before expiration, either at a gain or a loss. But you never hold the debit spread to expiration. You always exit before expiration. And when should you get out? Prior to expiration? The two rules of thumb is actually pretty straightforward. It's pretty much the same rules as outright buying a call or a put. You want to cut your losses when you've lost about 50% of the trade on a debit spread. And you want to take profits anywhere from 75 to 100% gain on your debit spread. So these are rules that, regardless of how you set up your debit spread, should be pretty much standardized. We generally find that it's really easy because no matter what strikes you choose, what expirations you choose, these rules hold for all debit spreads. When it comes to credit spreads, it's a little bit more, it takes a little bit more management. So I usually say that if you're going to trade credit spreads, get a few debit spreads under your belt just so you get a feeling for what trading these spreads feel like, because managing credit spreads does take a little bit more savviness. So number one, you want to enter a credit spread with a top or a bottom. So when you expect the stock has reached the ceiling, that's when you want to enter a call credit spread. When you feel that the stock has reached the floor, you want to sell a put credit spread. And you can string calls and puts together. A lot of people ask me, can I sell a call credit spread and then 2 days later sell a put credit spread on the same name? Absolutely. You can do that as long as you feel that the stock has changed directions. You can sell a credit spread. Now, the goal of credit spreads is to simply let them expire worthless. When you sell a put on a stock that you think has hit a floor, what do? The goal of selling that put is to let that put expire worthless. Exact same rationale when you're selling your credit spread. The part that needs a little bit more work is when you have to cut your losses, meaning if the trade goes against you, well, how do you manage that? So this is really, it depends on whether the premium that you receive on the credit spread is greater than 20% of the vertical width, so one fifth of the vertical width. So if you're collecting a $2 a credit on a vertical that's 10 points wide, that would fall under this category. That's when you want to cut your losses at 75 to 100% loss on the credit spread. If you're collecting 20%, less than 20% of the vertical width, so this is really when you're selling credit spreads that are relatively far away from the current price, that's when you want to cut your losses anywhere from 100 to 200% loss on the credit spread. So most of the credit spreads, if you follow our methodology, will fall under the first category. That's when you want to cut your losses, where you have 75 to 100% loss on the credit that you receive. So with that, what I want to do is I want to jump back to options play. I want to use the Apple example that I showed you before, and I actually want to point you to the P&L simulator to see how these strategies will perform. Now, before we start comparing the credit spread to the debit spread, what I want to do is I want to first make sure we're comparing apples to apples. So first, what I'm going to do is I'm going to say, let's say I'm willing to risk $2,500 on these three strategies. So here I can sell 3 contracts of the put credit spread. I can buy 3 contracts of the call debit spread. And let's actually see how these strategies perform depending on our views on Apple. So we talked about Apple's taken this pretty big beating over the last few weeks from when it was trading around 220 down to about 190. So, and we've discussed that 190 as certainly as some kind of support down here around 182, 185, which is where it bounced off yesterday. It was a low from yesterday. So there's at least some kind of temporary floor here. So let's say we think that the stock's going to stay at least above 192 or so. Let's just call it let's call it 192. Let's say we think the stock's going to stay above 192 here at expiration on December 28th. How does the credit versus debit spread compare? So I think it's pretty clear right off the bat that only the credit spread will give you any type of return if the stock stays where it is. Meaning if you bought a call or a call spread or a call debit spread and the stock doesn't go anywhere, you're actually going to lose money on both of these two strategies. But on the credit spread, you're going to be able to collect your full $885. That's how much you're going to collect on that premium. So as you can see, if I simply feel that Apple's reached the floor, I don't know that it's going to rally much higher, but I'm pretty sure it's not going to go any lower. This credit spread is clearly going to be the right strategy for me to trade. Conversely, that's what now we can start taking a look at other scenarios. What happens when the stock bounces up to 195, which is where it was just yesterday? Let's take a look at that, 195. So as you can see here, still, these two strategies here on the right is going to give me losses. Slightly lesser losses, but still, if I think the stock's going to rally $3, buying a call or buying a debit spread is not going to cut it. It's simply not a big enough move for these strategies to be profitable. Still, the credit spread is going to be better. So then we have to ask ourselves, well, do we think that this stock's going to bounce higher? Now, I think anyone that thinks that tech's going to bounce back will probably expect Apple to probably go back to at least maybe the 207, 208 level, which is where it was just last week. So let's say we think it's going to go to 208. Now, as you can see, the two strategies look far, far different. As you can see on the credit spread, I'm still only going to collect my $885. So not very good compared to buying a call or a call spread. So as you can see, even if the stock bounces back to where it was just a last week, which I think if you think that Apple can bounce higher going into the holiday seasons, you know, this is the December 28th expiration, which gives us all the way till the end of the year. You know, if you expect Black Friday or any of these sales to do well this year, I think a bounce back to 208 would be a conservative target in my opinion. As you can see here, clearly the call gives me $1,800 profit. The vertical 101% return or $1,800 profit, or $3,100 profit, 143% return, just on a move back to where it was a few days ago. This is my point about delta is your largest exposure when you're trading these strategies, not volatility. And I'll try to illustrate this. Let's say we think by the middle of December, which is well past Black Friday and Cyber Monday, we think that this stock can rally back up to 208, which again, I think is a conservative target. As you can see, $800 profit, $1,800 profit versus $2,100 profit. This is what I mean by using delta or your price outlook to determine your strategies. Because if you simply sold a credit spread, because volatility is very high on Apple right now, it's at almost 29%, which for Apple is really high. So even if volatility does come down from 28 to where it normally is, as you can see, the impact to my P&L is simply not large enough for me to be trading credit spreads just because volatility is high. We see a lot of users now selling credit spreads on Apple because, hey, volatility is high, so they learn that they should be selling credit spreads. But if they get the move that they're expecting the stock to bounce higher and volatility does come lower, which is the environment which credit spreads outperform, as you can see, the difference between those two is just a few dollars. That goes from 817 to 870. We're talking about an extra $60. Versus here on the debit spread, you're going to go from 2100 to 2300. So as you can see here, your volatility exposure, it's just $60 here and a few $100 there. Versus if the stock goes from even 205 to 208, you're going to get an additional $1,000 in profit. So your exposure to the stock moving is far, far bigger than the exposure to volatility moving. And that's why you should use these P&L simulators. Figure out where you think the stock's going to go. That's going to help you determine what's the most efficient way to deploy your capital. And if you're any more bullish on Apple, if you think it's going to go back to 220, even further. So here, if you think it's going to go all the way to 220, now it's telling you that maybe you should just buy the outright call, because now you're going to get a $4,000 profit versus only a $3,600 profit on the debit spread. So this is really where you can utilize our tool, put in any given scenario as to where you think the stock's going to go, and see exactly which strategy gives you the most efficient deployment of your capital, because now you can see actually side by side whether you should trade the credit spread or the debit spread. Don't just go off of, hey, volatility is high, so let me trade the credit spread, or volatility is low, let me trade the debit spread. That is really one of the reasons why we don't do a lot of IV ranking and things like that, because your exposure to delta is far, far greater than your exposure to volatility. Don't base your strategies just on a component of the trade that has relatively low impact on your P&L at the end of the day. So with that, what I want to do is I'll jump over to one more example. Let's look at Salesforce. Salesforce is one of those stocks that certainly has taken a beating, but I think is quite strong right now and certainly hit a bottom. Unlike Apple, which I don't know has bottomed out, but Salesforce has certainly gotten this W bottom, if you will, and I think this could rally easily to 140 or so on a move higher. But regardless, you can use our platform for both bullish or bearish moves. I actually think I had another example, and I don't remember what the stock was. Lastly, let's look at CRM as a bearish example instead. Let's say certainly I don't think it's hard for someone to argue that this might be a bit of a head and shoulders formation. I think there's a lot of downside risks to the downside. So this is a bit of a head and shoulders formation that, I think this can easily head to 113, 115, somewhere in that area. And conservatively, at least 122, 123 to the downside. So let's take a look at some bearish strategies. So, it's just trading around 133 right now or so, and that's been a resistance level here. So there's a few ways I can look at this. I can say that Salesforce is unlikely to go much higher above 133. And if that's the case, what is one thing that you can do is you can just sell a shorter call. You can sell a December 133 call, and what that's going to collect you is $725 for the call. But what we're going to do here is instead, because selling a outright call has unlimited risk, so let's say I buy a higher call against that, just to cap my risk. So here we go. Now, maybe 143 is not enough. Let's go to 147. We can go even a little further. Let's do that. 133, 149, roughly $16 wide spread. I'm collecting roughly a third of that, $539. So let's compare selling that call credit spread, because I think Salesforce is near a top. I don't think it's going to go much higher. So as long as it doesn't go much higher, I'm going to collect my money on the credit spread versus outright buying a put, which is much more tactical. This is expecting Salesforce to move lower. I'm going to buy a put. And then what we're going to do is we're going to compare that to buying a put vertical, which is, like we said, graduating from buying a put. Instead of just buying a 133 put for $875, I'm going to buy the 133 put and then sell a 115 put against that, so to reduce my cost to $582. So let's look at these three strategies. And before I do that, let's first normalize this and say I want to sell. I'm willing to risk $5,000 on this trade, so that we're comparing apples to apples now. And let's say we think Salesforce is going to stay around 133, because I just don't think it's going to go much higher. I think it's going to stay around where it is. As you can see clearly, if I bought the put or the put vertical, not a good result for me. But if I sold the credit spread, I make $2,100. There's no other strategy in the world that gives you this type of profit just for the stock not going anywhere. And that's really one of the benefits to trading credit spreads is that when you expect the stock to be neutral, you can still make money by selling credit spreads. Conversely, if let's say the stock does make it down to 125, a small support level, 125, 122, I think those are fairly conservative targets to the downside. As you can see here, now the call is just basically at break even. And this is really one of the reasons why you want to trade a debit spread. As you can see, the difference between paying just a little less for that debit spread versus the credit spread, outright put, is a $1,700 profit on the debit spread and only a $90 profit on just the outright put. So this is the reason why you want to consider taking a look at the debit spread versus just buying a put if you're conservative. Now, as you can see, if we go to 122, wow, the difference between selling a credit spread where I'm only making a $2,100 profit versus the debit spread is double. So as long as the stock moves down to 122, which is a $10 move. So this stock moved from 142 to 132 in a matter of 5 days. So expecting to make another $10 move to the downside in the next 45 days, I certainly don't think is out of the question. And that's why buying a debit spread here gives me that risk reward that I'm really looking for if it does move lower. And this is risking the same amount of money. I'm risking 4,200 here, 4,600 there. And if the stock does make a small move to the downside, I'm going to be far better off on the debit spread than I am on the credit spread. Again, Delta is your largest exposure, not Vega. So let's now look, I said that I think this stock can move, to the downside easily to 116 maybe if it doesn't really start to slide, and tech does look quite weak. If you look at the NASDAQ 100 index, it just closed below its 50-week moving average, which is a fairly significant moving average to be looking at. So if it does move down to that 116 level, which based on the way that tech is looking right now, the weakness that we're seeing, I don't think is out of the question. As you can see here, I'm going to make a $9,000 profit on debit spread versus a credit spread. Again, this is one of the reasons why you don't want to optimize your strategies just based on volatility. You want to optimize your strategy based on your outlook on the underlying stock, because if you chose a credit spread just because of high volatility, which is what we're seeing right now, CRM at 41 vol is pretty high. If you're going to sell credit spreads, you're going to be a far suboptimal way of deploying your capital for the same directional move that you're expecting. In this particular case, for the same amount of risk, you're going to make quadruple the profits of a credit spread. And this is one of the reasons why we want you to make sure you understand these strategies in and out so that you're choosing the right strategies for your outlooks and deploying your capital as efficiently as possible. So with that, what I want to do is I just want to jump back to options play, the slides. Just before we open this up for Q&A, I just want to remind everyone we have a new credit spread trading signal service. This is a signal service we just launched 3 weeks ago. We've gotten quite a few trades in. We're very happy with the success of the strategy so far, and we have a special introductory pricing for those of you that are interested in learning more about this. We're basically sending daily credit spread trade ideas. They go out between 2 to 4 p.m. every single day. The average return on the trade is about 11% based on our back testing. We're actually averaging much higher in the live signals so far, but it's only been 3 weeks, so it's not enough to really go off of. And you can get that at stocktwits.com/r/option-play-signals. And for those of you that are interested in selling credit spreads, these are back-tested technical signals from 1999 to 2018. We've back-tested optimal credit spreads off of those technical signals. And they are generally 4-week credit spreads that you hold them mostly to expiration. This service does require you to sign up for a free StockTwits account, which is free. Anyone can sign up for that. And keep in mind that this is separate from your options play subscription. So if you're interested in that, take a look at stocktwits.com/r/optionsplay. So with that, I just want to thank everyone for taking the time out here this afternoon. At this point, what I'll do is I'll open this up for Q&A. For those of you that have any questions regarding anything that we talked about here, please type them into the chat window or in the Q&A window, and I will answer as many questions as I have time for. Could you also cover risk control? I don't know what you mean by that question, so if you could please give me some information on that, please let me know. Do you need to have a margin account to trade spreads, or can it be transacted in a cash account also? Generally speaking, you need a margin account. So that, David, I think the best person to ask is actually your brokerage firm. They'll be able to tell you about what you need to do in order to trade spreads. I certainly have a margin account. I've never traded in a cash account before, so I would certainly look at that for you. Isn't being an option seller more better in the long term than an option buyer? I think my illustrations here with the CRM and on the Apple plays certainly show that one is not better than the other. It really depends on what your preferences are. I think that's an overgeneralization of option selling and option buying, as if the two are absolutely the same, and then you just have to pick between one or the other. I think it highly depends on your strategy. I think it highly depends on the expirations and strike prices you choose. So what we're here to do is teach you how to efficiently deploy your capital for either one. What is the exit formula for a neutral play, like a calendar? Great question. That's a completely different strategy. I'm happy to answer that question, but Mike, if you want to send me an email at info@optionsplay.com, I'm happy to try to answer as much as I can. How much is the tool? This options play tool that you're seeing here is $50 a month or $500 a year. You can sign up for a free trial at optionsplay.com just to test it out before you have to subscribe to the tool. What criteria do you use to select a stock purchase versus options play? What do you mean by stock purchase versus well, you use the P&L simulator. So we use the P&L simulator. So let's say instead of CRM here, let's say I'm bullish on CRM, and you're trying to decide whether you should buy the stock or you should buy the option, right? So here you buy the stock, it's $1,300 or $13,000. Buying an option is $825. Buying the debit spread $697. The question to ask yourself is, how bullish am I on Salesforce? Do I think the stock's going to go to 143? If you do, you plug that in, and you can see, would I rather make an 8% return and risk $13,000, or would I rather make a 57% return and only risk $697? I think the answer for most people will be this debit spread, because just in case that you're wrong, you're going to risk substantially less on the debit spread than you do if you buy the stock. So that's how we determine whether we want to buy the stock or we want to buy an options, is using the P&L simulator and say, what happens if we're right? How much money do we make? And if we're wrong, how much money do I lose? And you weight the two. And that's really what the options play score is telling you, is how much risk reward is in each one of these strategies so that you can compare them. Is it better to let a winning credit spread to expire or close the day before expiry, before the market closes? So that depends on the strikes. So if all the strikes are out of the money, you can just let it expire worthless. It really depends on how close you are to your break-even price. If you're very close to your break-even price, I usually say close it out. If you're far away from your break-even price, let it expire worthless. Chris is asking any performance details on the stock with signals. I just sent a link in the chat window to the current performance tracking as of today of all the signals. When a debit spread's going bad, when would you exit? I think I covered that in one of the slides. If you want to review the slides and the recording, they'll be sent out about 30 minutes after we finish here today. Any other questions? What is your options background / experience? So I spent about 7 years in currency trading. That's really where I learned all of my technical analysis. That's when I became a market strategist, working with clients pretty much from all different types of backgrounds. That's when I learned how to do intermarket analysis, looking at interest rates, looking at commodity markets, looking at currency rates, looking at a little bit of equities and mostly the indices at the time. And that's really how I learned how to analyze the markets. And then we started Options Play about 7 years ago, after I had spent about 5 years trading options on my own and not really finding the tools that I needed. And I found that the tools that were available out there from the brokerage firms required a lot of manual work. And if you've ever used the option chain before, this is not a great experience. I used to have to scroll through pages and pages and pages of this. And even as a professional, I've got pretty good at using these pages. But I couldn't get all the information I needed. So should I sell the 166, 169 credit spread, or should I sell the 167, 170 credit spread? How do you compare those two? Or should I buy the debit spread, or should I buy a call instead? These are all questions that were not answered by the option chain. So what we found ourselves doing was constantly going between this types of page and some other analytics page. Many of you trade at Thinkorswim, or you find that you are constantly flipping between the option chain and the analytics tab. This was the back and forth that we got sick of, and that's how we started Options Play. We wanted to put strategies that we wanted to look at instantly in front of us, because choosing the same calls every single time required a lot of work on the option chain. Here, all I have to do is type in a symbol, and it gives me the starting points that make sense. I can modify them if I want. I can change the strategies if I want, but it gives me starting points and allows me to compare 3 strategies side by side. That's really why we started Options Play. So that's a little background on kind of my experience and how we got here. Once in a trade, how do we use a simulator to check returns possible as the trade continues? So one of the things that you can do is you can click on this little blue share button. So let's say you want to trade this debit spread on Salesforce. You can click this blue button, and there's a button here that says copy to clipboard, or any of these, you can email it to yourself. Any of these things will save the trade. So let's say you save the trade. This will allow you to save a trade, and you can track all your trades in your profile. So you can go to your profile, you can go to save trades, or share trades rather, and all the trades that you've ever done are here. So let's say I looked at this SPRY vertical a few weeks ago. As you can see, when you click on that, what it does is it brings up that spread, and it'll show you how that trade is done since, and you can use this with the P&L simulator. So now if the stock was to continue going down to 230, how much profit do I make? This will allow you to do all of this type of scenario even in a trade that you're currently in. So that's one of the best ways that you can track an existing trade. Doyle, thank you so much. I really appreciate it. Those frustrations is really what caused us to build this platform. How do you select your daily recommendations? Great question. So those are handpicked by me and my team. We look at a bunch of factors into determining, but for the most part, they are technical factors. We're looking for stocks with bullish and bearish trends. We do a top-down approach. So if you want to follow our previously recorded webinars, we do one on directional edge. A lot of the stuff that we teach there is how we go about selecting our daily recommendations. It seems that any strategy in which the underlying must increase in order to make a profit is not a good plan. Most stocks decrease. Well, I would actually beg to differ. 54% of days stocks go up, 46% of days stocks go down. So you currently have more of an edge on the plus side than you do on the downside, and the average move to the upside is about 1.06, I believe. Average move on a stock moving up, and 1.16 move to the downside. So stocks move higher more often, but stocks to the downside move a little more to the downside per day. What video can you recommend to learn more about basic spreads? So if you look at our YouTube playlist, which is the link is included in the slides when I send to you, the 2 basic spreads are credit versus debit spreads. So today you've got a taste for each one, but if you want to learn more, I certainly recommend you to look at maximizing your profits with debit spreads, for those of you that want to learn debit spreads, and then maximizing your income by credit spread selling. So those are the two webinars that I would look at for debit spreads and credit spreads if you want to learn more about those. Chuck, thank you so much. I really appreciate it. Raymond, I would prefer to trade debit spreads, but my platform wants me to demonstrate options trading covered calls, long puts, before they let me trade multi-leg strategies. So I guess that depends on your broker and what you need to satisfy them in order to trade these spreads. I unfortunately can't speak to that. So I wish you best of luck, and I hope you can trade debit versus credit spreads, because they are by far 2 of the most efficient ways for you to deploy your capital, regardless of whether you're bullish or bearish or neutral on an underlying stock or ETF. Do you have a rule regarding what percentage of a trading account should be risked on a single debit spread? Absolutely, really good question. So we usually as professionals will always tell you that we don't risk more than 1 to 2% of our entire account on any single trade. So if you're risking 1% of your account, that means you need to have 100 losing trades in a row before you blow up your entire account. If you risk 2%, you need 50 losing trades in a row to blow up your entire account. But if we think about it, if you're risking 5% of your account, you only need 20 trades in a row or 10 trades in a row to blow up half your account. And that's why professional traders will usually risk no more than 1 to 2% of their entire account on any single trade. Doesn't matter whether it's a debit spread or a credit spread or anything like that. Any single trade should not risk more than 1 to 2% of your entire trading account. Can I add a stop loss order to limit the losses on a credit and debit spread? Absolutely, but that heavily depends on your broker. Not all brokers support stop and limit orders on spreads. Most of them do, most of the major brokers do, but I don't know where you trade, so please ask your broker. Most brokers should be able to accommodate that. Can you review the circle slash colors and score on the inside? Okay, so I think we're referring to these options play scores. This is really looking at the potential reward or the potential green that you see on your P&L graph versus the potential red, the risk on your P&L graph. And what we're doing is we're weighting the two by each other and also at the same time weighting the probability of you reaching that successful trade and versus the probability of risking that amount. And that's how we get the options play score. And the best way to illustrate this to show you is, let's go back to our Apple example here. So here, as you can see, the goal here is to show you which strategy gives you the highest potential reward versus the least amount of risk to the downside. And that's really where the options play score is coming in, is we're looking at the potential opportunity to make profit, 150% profit versus the 9% profit, and then how much money do you lose if you're wrong. And that's really how we derive the options play score, is the risk to reward ratio of each one of these three strategies. The reason for this is because if you look at call strategies, you have unlimited max reward. How do you calculate risk reward on something that has unlimited reward? And that was one of the struggles that we came across as traders. So we wanted to create a formula that allowed us to compare the risk reward of all strategies. And that's how we came up with the options play score. Raymond, thank you so much. I really appreciate it. Alexander, regarding your question about first trade, why don't you send me a separate email at info@optionsplay.com, and I'll answer your question regarding first trade. Any other questions? Are all your verticals debit? If you're referring to the ones that we send out in the email for free every single morning, yes, those are always debit spreads. Those are all trades that we expect the stock to make a significant move. But if you're interested in trading credit spreads, like I said, we've offered this new credit spread trading signal service. And the reason we offered this is because we did a customer survey. 75% of you said that you like trading credit spreads or you prefer trading credit spreads. So we didn't want to alienate those of you that trade credit spreads. So we wanted to launch a service that provided credit spread ideas to you guys as well. Any other questions? If there are no more questions, I just want to thank everyone for taking the time out this afternoon. Next week, we have a new topic, selling cash secured puts as an alternative to outright buying the stock. I think pretty interesting topic in this market environment as we had this huge sell-off. I think a lot of opportunities to pick up some stocks. Volatility is really high, so selling puts is generating quite a bit of yield. And the sell-off does provide some opportunities to get into stocks at a much cheaper valuation than you were able to purchase them a month ago. So really being able to benefit from this higher volatility environment by selling outright cash secured puts if you have the cash to do so, and potentially dollar cost averaging into some stocks at a much lower cost. So that's what we're going to be talking about here next week. Excited for that new topic for you guys. And if there are no other questions, I just want to thank everyone for taking the time out this afternoon. I know this was a bit of a refresher, but I did mix things up and kind of go a little bit more in depth into the rationale behind trading credit versus debit spreads. I hope you guys found that useful. And thank you very much. I really appreciate it, and I hope you guys have a great afternoon. And I will be sending out the recording in about half an hour. So I'll see you guys next week. Have a great evening.